Well, congratulations and welcome to week 4 lecture for Accounting 233 Income Tax. I say congratulations because you have covered a lot of material this last 3 weeks, and this is your 4th week, and you're getting ready for your final exam or your assignment, whatever you want to call it. I'm going to hop right now and go to the actual classroom and show you what you have in store for week 4. Basically, like always, there's no discussion forum. There's a reflection on the class, and I would love it to see how you thought it progressed. Week 4 final assessment. Usually you're used to multiple choice questions. Sorry to tell you that it's not that case with income tax. This is a final assessment and it's worth 180 points. And you are to complete the following tax returns: 1040 and the Schedule A. Now we have covered all this material. There's nothing that should be a surprise in this assignment. So let's go over it. Following is a list of information for Peter and Amy Jones. Right there, I think they're married. For the current tax year, Peter and Amy are married and have 3 children: Aubrian, Bryson, and Caden. They live at 1846 Joplin Way in Lakeville, Minnesota, zip code 55044. He is a lawyer and Amy works part-time at a genetics research lab. The Social Security numbers and ages are as follows. And I'm reading this to you so that you can follow along. I know you can read, don't take it that way. But specifics you need to pull out of this assignment, I'm trying to give that to you. Peter, this is his Social Security number, and he's 32 years of age. Amy is 28, and this is her Social Security number. The 3 children are 5 years old, 3, and 1 years old, and these are their Social Security numbers. Now, they give you Peter's salary of $70,000 and Amy's at $32,000, and they had federal taxes withheld from their paychecks of $10,500. Items they want you to consider for their itemized deduction is they do have eye glasses and eye exams for Aubrian, $600. They have orthodontic work for Bryson to correct a congenital defect of $2,500. They have medical insurance premiums of $1,800, and they do have withholding for state income taxes of $7,200 and taxes on property on their property tax on their home of $1,100. They have interest on that same home of $9,700. Now your resources, you have the actual Form 1040, the Form 1040 Schedule A, and the instructions to these 2 forms. And I'm going to pull them down for right now so you can see what they are. Okay, so here's the schedule. This is the 1040. Okay, here it comes. And it is a fill and sign return. You can actually type in Paula White. Well, I don't know why this is doing it that way. Here we go, Paula White. but it says only first name. That's probably why it doesn't like me. Tab over white, tab over social security number. That is not my social security number. Spouse's social security number, home address. You're going to fill in the form live, and you can actually save file, save as, and I'm just going to say test for lecture 4. I'm going to save this to my download and prove to you downloads. Test for lecture 4. Open it up. And here it is. Test for lecture 4. And what I typed in stayed in there. So you just fill the form out, do the calculations, and file save as. And then when you get these 2 files completed, you upload them as your final exam assignment. Now let's just make sure that you see that here's the Schedule A. Because I do not want any surprises from you all or to you all because I didn't cover something. Here's a Schedule A form. Here's your itemized deductions, and it's also a fill-in version of the form. You can click on any of the purple spaces. Click here, income taxes for state. I just typed in an X and it gave me a checkbox, and so my state income taxes is $5,000. And file, save this, and you actually have to calculate your calculations and your subtotals. And then this itemized deduction will transition into the total here. If they can itemize, and I believe they can, this total will go on the page 2 of their 1040 as the itemized deduction and not use the standard deduction. I don't want to save the changes in this time. And then you have the 1040 instructions and the Schedule A instructions. Just to make it easier for you, you don't have to go to the textbook now. You can actually go to the 1040 instructions. And these are the instructions from the IRS. This is real. 1040 instructions. And here it is. And in my version of it here, it's got the structure of what comes next. A first-time home buyer tax credit. It's got everything on here. I don't know. It's 214 pages. And you can actually, given that you know your stuff by now, you can actually do a search. Where's my search button now? View, edit, find. Where's my find button? Edit, find. You can type in what was one of the situations. It was medical. Oh no, it's medical is going to be on the Schedule A. filing status. And it's going to find every place that filing status is printed. Page 133, 4, 5, 6, 7, 8, 9, 10. So it's finding filing status. If your filing status is married, filing separate. So you can do a lot of searching if you're not extremely confident. You can search on the subjects that you need help on within the same document. So that's the 1040 instructions, and here you have Schedule A instructions from the same source. It's the IRS, and it's for the same tax year 2012, which is where the forms are. Examples of medical and dental payments you can deduct. And you just kind of read through it. And basically there's 3 columns to each page. And this happens to be a 15-page document. But it really spells it out. And this is one of the sources that when you actually do tax returns professionally, you go to these resources every single day that you're in the business. I'm going to show you some other resources later in this hour, but first I want to review the other 3 weeks so that you can have a stronger position going into this final exam in this course. Okay, so in week 1, the homework in week 1, that's where we introduce to you the 1040. Okay. We had a problem in chapter 1 about Letitia. She was a single taxpayer, and she had the following income and deductions for the tax year. That you were given this information, and you were asked to compute her taxable income and federal tax liability. Then you were also asked to compute her marginal, her average, and her effective tax rates. So we have salary, business income, interest income from bonds, and interest income from tax-exempt bonds coming up to $100,000. Deductions included business expenses that were related to the business income, itemized deductions, and personal exemption. Now the answer is to compute her tax liability and federal income tax. I'm sorry, their taxable income and federal tax liability. We basically took her salary is certainly taxable income. Business income, yes. Interest income from bonds, yes. But tax exempt is exactly what it says. It's exempt from taxes and therefore is excluded. That's why I scratched it out. So instead of $100,000 for gross income, she has $95,000. Less her deductions, the business expenses are valid because she has business income. You have itemized deductions, the personal exemption. So all these deductions added up to $33,300. Subtract that from $95,000 to get taxable income of $61,700. And I went to the tax table and looked up $61,700, and this was a tax associated with that income level for a single individual. Now let's compute her marginal tax rate. In that IRS instructions, you're going to see the tax tables in there too. This will be the tax tables will be in the 1040 instructions document. And you're going to see the tax tables. You can actually find the exact amount of income and come up and find and go to the married filing joint column, and that will be the taxable income. Or you could go to the same type of thing, Schedule X. If your filing status is single, you find the married filing joint version, and this is the tax tables. Taxes are progressive. The first in this year, the first $87,000, if you're single, did not have any tax at all. Then after the $8,700 to $35,350, you have a 15% taxable income, and then you also have 10% on the $8,700 that was your base. So that is your $8,700 here. I'm sorry, the tax is $870 plus 15% of the amount over $8,700. That's because the first level, $8,700, is still taxed at 0. Anything over $8,700 is 15%. Then it continues. Anything over $35,350 is at 25%. These percentages right here are considered the marginal tax rate, because once you get to a certain taxable level, if you earn $1 more of taxable income, it will be at the 25% tax rate. If you currently earned $85,650 and then you got $1 more, that dollar, the additional dollar, will be taxed at 28%, and so on. So that's the marginal tax rate. Oops, hit the wrong button. So her average tax rate is simply the federal tax liability, the $11,425 that we calculated, divided by the taxable income. This is the blended average of all those tax rates. It's the blended average of all of these tax rates, which is, in her case, 18.52%. Then Letitia's effective tax rate. It's the effective tax rate because basically you take the federal tax liability and her earnings. In this case, it would be the total income, including the $5,000 of tax-exempt interest, and then subtracted her business deductions. This is her actual activity, her actual income activity. So that tax rate would be 12.62%. That's her effective tax rate. So we went on to chapter 2, and we had a problem in number 30. And the following information related to Tom. He was single and he was 18 years of age. He had salary of $1,800, interest income of $1,600, and itemized deductions of $600. And we were supposed to figure out his taxable income, assuming that he supports himself. That means his parents and no one else is taking him as a dependent. He is self-supporting. And then we want to calculate the same thing if he's a dependent of his parents. And how does this change? So if he's self-supporting, he has to claim his salary, he has to claim his interest, which is his AGI of $3,400. He gets to take the standard deduction, the full standard deduction that anyone else who's over 18 can take. And he gets to take the whole $3,700 just as if he was not 18. So 3,000 minus 5 minus 3, he has 0 taxable income. As he is self-supporting, he gets his standard deduction and his exemption normally. Now he is a dependent, part B was he is a dependent of his parents. So the book stated that the dependent standard deduction is reduced to the greater of $950 or the taxpayers, the dependents, earned income plus $300. That's currently $350, but this is 2012 information. So salary, that's his earned income. Interest is unearned income. It's just you get it by the passage of time. But his salary is earned income. So $1,800 plus $300 is $2,100, and is that greater than $950? Choose the higher. So standard deduction that he can take is $2,100, which is the $1,800 plus $300. He cannot take the exemption because he's a dependent of his parents. He's still living at home. His parents is providing more than 50% of his living expenses. They get to take Tom as a dependent on their tax return and take the exemption. And they'll probably get bigger bang for the buck on their tax return using this exemption than he would. So his taxable income would be $1,300. So $3,400 minus the $2,100. And then you had problem 2-39. You were given 4 or 5 scenarios. I didn't type the 5th one in here. No, there were 5 scenarios, and you were supposed to tell me what the tax form is that they could qualify to use, what their filing status was, single or head of household, how many personal and dependents exemptions could they take, and the number of children in their scenario that qualified for child credit. Okay, so that's that week. Let's go to week 2. And that talked about inclusion and exclusion from income. And we covered the actual form that week of the 1040 in detail. And I'm going to show you the quick finder and talk about enrolled agency later on today. So similar to Chapter 3, Problem 53, it was about court awards and insurance settlements. You were asked what amount, if any, must be included in gross income by the following taxpayers. Anne received $2,000 from her insurance company when her automobile, which cost $3,000, was stolen. Let's continue. Barry received $3,000 from his brother. He had initiated a lawsuit against his brother in an effort to recover $3,000 he had previously loaned to him. The brother paid him back before the case was tried, and Barry dropped the lawsuit. Is there anything taxable in there? And Carrie, an accountant, sued a client in order to collect her fee for doing tax work. Would her accounting method make any difference in that situation? And 4th, Dave had incurred $6,000 of medical expenses so far this year. He paid $400 of them himself. His insurance company paid $4,000. The hospital is suing Dave and the insurance company for the balance, $1,600. Remember, what amount, if any, must be included in gross income, not deductions? So the answers for Anne, remember she had $2,000 from her insurance company because her car got stolen, which she paid $3,000 for. It was not it's not taxable income because it's recovery of capital. She lost the $3,000 asset and she recovered $2,000. Barry, there was no mention of interest in this question. Basically, he received $3,000 from his brother. He had loaned his brother $3,000 and he paid it back before they actually had to go to court. So it was a repayment of a loan. There is no earning of taxable income there. We'll talk about Carrie in a moment. And Dave had incurred $6,000 of medical costs. This is more like the deductible, itemized deductions of medical expenses, and it's not a deduction. It's not an income for him. It would probably be more in the deduction category. So it's a red herring. Let's talk about Carrie. She's an accountant and she sued her client in order to collect her fee for doing tax work. Well, if she's on the accrual basis of accounting and recording her taxes, she would have already had it in her. She would have already had it in her tax return and taxable income. I'm going to pause this for a moment and go where it's going to be quiet. I'll be right with you in 2 seconds.